Welcome to Talk Tickers. Usually we're here breaking down the latest earnings prints or, dissecting guidance from the C-suite. But today we're doing something a little different. We are cracking open the hood on a market mechanism that drives price action just as much as, say, a revenue beat or miss. It's arguably the most misunderstood, vilified, and yet technically complex engine in the entire financial system.
It really is. It's like the dark matter of the market. You know it's there. You can see its gravity affecting prices, especially after a controversial earnings report. But very few people actually understand the physics of it.
We're talking about short selling and securities lending. And specifically, we're going to use the events of January 2021, the whole GameStop saga, as a kind of forensic case study.
Right.
Not to rehash the memes or the social media frenzy, but to really understand the plumbing that nearly blew up the National Securities Clearing Corporation.
Exactly, because while the public discourse often gets stuck on this narrative of betting against success, the real story for an experienced investor is about liquidity thresholds. It's about clearinghouse capital requirements.
And what happens when the mathematical models that govern the market just break?
Right.
When they encounter a discontinuity.
Right.
So let's unpack this. We've gone through a stack of regulatory reports, academic papers on clearing prices, all of it. The mission today is to move past that good versus evil narrative and get right into the mechanics of the trade.
Yeah, we need to understand the technical execution of a short sale, the whole controversy around naked shorting, and the mathematical feedback loops that actually create a squeeze. Because as we're going to see, high short interest alone, it doesn't trigger a squeeze.
It's about something else.
It's about specific liquidity limits being breached.
Okay, let's start with the snapshot then. At its core, short selling is. It's just borrowing a security to sell it, hoping to buy it back later at a lower price.
Right. It's a risk transfer, plain and simple. But the stakes are completely different from a standard long position.
Right. A long position, you buy a stock for $100, the most you can lose is $100.
Correct. Your loss is limited to your principal. A short position, though, has theoretically unlimited losses. If the price goes to infinity, your liability goes to infinity. It's a fundamental asymmetry.
And that asymmetry completely changes how you have to manage risk.
The landscape has really shifted, too. I mean, this used to be a niche hedge fund strategy.
Oh, for sure.
Now, with regulation SHO and new reporting rules like 13F2, it's become the central topic of retail liquidity and regulatory reform.
Exactly. And the headline result from everything we looked at is this. A short squeeze isn't just about sentiment, it's a structural failure. The key insight is that market discontinuity, where a price jumps mathematically instead of moving smoothly, that's triggered by clearinghouse mechanics.
So it's not just more buyers than sellers?
No, it's about the plumbing of the market literally running out of pipe. Okay, let's get into the gears of this, the historical and technical context. How does the trade actually execute? Because I think a lot of people think you just click sell on something you don't own.
Not legally, no. You need a locate. Under regulation SHO, before you execute a short sale, your broker has to have reasonable grounds to believe the security can be borrowed and delivered by the settlement date.
And this brings us to securities lending, the desk in the back office of every major prime broker.
Right. Brokers lend shares from margin accounts from institutional portfolios, and this creates two classifications for stocks: easy to borrow, ETB, and hard to borrow, HTB.
If a stock is easy to borrow, the fee is tiny, almost nothing. But if it lands on that hard to borrow list, that's when the economics of the entire trade can flip on its head.
The cost to borrow, the fee you pay the lender, can just skyrocket. In extreme cases, like we saw with GME in 2020, this fee can go over 100% annualized.
Let's just pause on that. 100% annualized. That means if you hold that short position for 1 year, you've paid the entire value of the stock just in fees.
Exactly. It acts as this massive soft constraint on shorting. It forces you into a short time frame. If you're paying that kind of rent on your position, you need the stock to drop right now, or you are just bleeding capital every single day.
So you have the borrow fee, but then you have margin requirements, which are the hard constraints.
Yeah, Regulation T requires 50% initial margin, but the real killer is the maintenance margin. It's typically 25%, but for volatile stocks, it's often much higher. If the stock price goes up, your equity in the trade shrinks. If it drops below that maintenance level,
you get the dreaded call, the margin call.
You either have to deposit more cash immediately, or you have to buy back shares to cover your position.
And that buyback, That's the spark for the squeeze, isn't it?
That's the spark. And this is where the academic work gets fascinating. There's a concept called the discontinuity threshold. Let's just call it STAR.
Okay. Is this like the point of no return?
Essentially, yeah. Below this threshold ratio of short interest, price changes are continuous. The market absorbs buying and selling in a smooth, linear way. But if short interest goes above this STAR threshold, and then you introduce a certain amount of outside capital, let's call it C-star, the clearing prices become discontinuous. They jump.
So it's not a slope anymore, it's a cliff.
Yeah.
Or I guess a vertical wall going up.
It's a vertical wall. The demand to close positions to satisfy margin calls instantly overwhelms all available liquidity. The market becomes structurally unstable. It's not emotional. It's just algebra. The clearing algorithm literally cannot find a price that satisfies all the demand.
This brings us to the most contentious term in this whole space, which I see constantly, naked shorting. They sold shares that don't exist.
Right, and we have to be really precise here because this term gets thrown around a lot. Naked shorting is selling a stock without borrowing it or arranging a borrow. For most people, it's illegal. But there's a huge exception that fuels all the theories.
The market maker exception.
The market maker exception. Bona fide market makers. The wholesalers who facilitate trading. They're allowed to short without a locate to provide liquidity. If you want to buy and they don't have the stock, they sell it to you short to keep the market moving, and they plan to find the shares later.
So it's like a bridge. They're bridging a gap between a buyer and a seller who haven't quite met yet.
It's a great way to put it. But when they don't find them later, that's when you get an FTD, a fail to deliver.
Which happens when the seller doesn't deliver the securities by the settlement date. Back in 2021, that was T+2.
Right, and persistent FTDs can create this illusion of phantom shares, more shares in circulation than actually exist. This leads to theories like seller boxing, the idea that they're flooding the market with fake shares to drive a company into bankruptcy.
But looking at the actual data for GME, the regulatory reports, what was the reality? Was there a seller full of fake shares?
The reality was less nefarious and maybe a bit more boring. Fails to deliver did spike significantly, but they were generally cleared within a few days. It looked more like an administrative lag in a system just completely overwhelmed by volume, not a massive fraud of counterfeit shares. The pipes were clogged, but the phantom share theory isn't really supported by the settlement data.
A plumbing backup, not a crime scene.
Got it.
Okay, let's pivot to the deep dive. The GameStop case study, January 2021. This is the stress test for everything we've just laid out.
The setup in 2020 was just unprecedented. Short interest was hovering around 100% of shares outstanding. On December 31st, 2020, it hit 109.26%.
How is that even mathematically possible? How can you short more than 100% of an entire company?
Rehypothecation.
Okay, let's unpack that, because it sounds complicated, but it's really just a chain of lending, right?
It's just a chain. Think of it like this. Person A lends a share to person B. Person B shorts, it sells it to person C. Now, person C owns the share.
Right, person C is the new owner.
But person C has a margin account. So person C's broker takes that same share and lends it to person D.
Who then sells it to person E.
Exactly. So physically, there is only one share of stock. But economically, you have multiple people with long exposure and multiple people with short exposure, all against that same single share. It's a chain of IOUs. That's how short interest can go over 100%.
And we saw this same weirdness in ETFs, right? Like XRT.
Yes, the retail ETF XRT. Short interest there sometimes exceeded the shares outstanding of the ETF itself because of the creation and redemption mechanism. Institutions were shorting the ETF to hedge or to get short exposure to GME when borrowing GME shares directly was just too expensive.
So the powder keg is set. January 2021 comes around. The price runs from about $20 to $483. The narrative everyone knows is that this was the mother of all short squeezes. Retail broke the hedge funds.
And here is where it gets really interesting. If you actually look at the consolidated audit trail data, the CT data, that narrative is mostly wrong.
Wait, really? The shorts didn't cover?
No, they did cover. Hedge funds covered huge positions between January 22nd and January 27th. But, and this is the critical correction to the narrative, that short covering was only a small fraction of the total buy volume.
So who was buying?
Everyone else. It was primarily positive sentiment and long buying. From retail, from other institutions just catching the momentum. The price was sustained by aggressive buying, not solely by a mechanical short squeeze.
That is a huge distinction. It wasn't just Melvin Capital buying back for their lives. It was a pure momentum trade. What about the gamma squeeze hypothesis? The idea that market makers had to buy stock to hedge all the call options being bought.
The data doesn't fully support that either. I mean, yes, retail was buying calls, but they were also heavily buying puts. And critically, market makers were actually buying calls in many cases to hedge their own books. There was no clear textbook gamma squeeze driving the price.
So if it wasn't a pure short squeeze and it wasn't a gamma squeeze, why did the market break? Why did brokers turn off the buy button on January 28th?
This is the most critical part of this whole thing. It wasn't some conspiracy to protect hedge funds. It was a clearing crisis.
The NSCC.
The National Securities Clearing Corporation. They're the central counterparty. They guarantee every trade. And to do that, they require a clearing fund from brokers to ensure that if a broker goes bust before a trade settles, the system itself is safe.
And extreme volatility drives that margin requirement way up.
Violently. On January 27th, the volatility in GME and a few others drove the total NSCC margin requirement to $25.5 billion. Intraday margin calls totaled $6.9 billion.
That's almost $7 billion that brokers had to find in just a few hours.
And it gets worse. There's a rule called the excess capital premium, or ECP. It's a penalty charge. If a broker's risk exposure gets too big relative to their capital, the NSCC just slams them with a massive surcharge.
It's like an overdraft fee on steroids.
It's designed to stop brokers from taking on too much risk. One specific broker, and we can guess who, faced a potential $1.4 billion ECP charge. That was double their entire margin requirement.
So they were facing default. They were facing liquidation by the NSCC.
Effectively, yes. If they couldn't post that cash, the NSCC liquidates them. The NSCC actually waived the ECP charge on the morning of January 28th to stop broker defaults from happening. But the condition, whether it was implicit or explicit, was that brokers had to cut their risk immediately.
And the only way to reduce risk is to stop the buying.
Exactly. They restricted buying GME not to protect hedge funds, but to limit their own clearing fund requirements and avoid being put out of business by the NSCC.
That completely changes the framing. It wasn't market manipulation from the top down. It was a solvency crisis from the bottom up for the brokers.
The plumbing just couldn't handle the flow. The T+2 settlement cycle meant there was just too much risk floating around in the system for 2 whole days.
Which brings us to the investor context. What's changed since then? We can't just leave the plumbing broken.
Well, regulation is evolving. We now have rules like SEC Rule 13F2, which requires big institutional managers to report their gross short positions.
With some more transparency.
More transparency and better tracking. The Consolidated Audit Trail, or CITT, is making it much easier to monitor for compliance and identify that naked activity we talked about.
And the big one, the settlement cycle.
Right. The push to shorten settlement from T+2 to T+1, which is happening, and eventually to T+0, that's the real game changer. If trades settle faster, you reduce the counterparty risk that caused those massive margin spikes in the first place.
Let's zoom out to the philosophy of it all. Market efficiency versus ethics. We've got listeners who short and listeners who think short sellers are the enemy.
Well, the bull case for shorting is that it provides liquidity and it acts as a check on corporate fraud. I mean, think about Enron, Luckin Coffee.
Nikola.
Short sellers were the ones who blew the whistle on those.
They're the detectives. They have a direct financial incentive to find the truth when everyone else is just buying the hype.
But the bear case is the short and distort campaign.
Right. This is where sellers actively spread false rumors to drive a price down.
Yeah.
It's straight up market manipulation.
The reverse pump and dump. Precisely. And in the age of social media, it's a very real risk.
So what does this all mean for the experienced investor listening right now? You're looking at a stock, you see a high short interest. Do you jump in, try to catch the squeeze?
You have to be so careful. The lesson here is that high short interest is necessary, but it's not sufficient. You need to ask one question.
Which one question?
Is the short interest in this security approaching the days to cover liquidity threshold relative to its average daily volume?
Why does days to cover matter more than the raw percentage?
Because the raw percentage is less important than the ability of the shorts to actually exit their positions. Even if short interest is high, if the volume is huge, shorts can get out pretty easily. But when days to cover spikes up and borrowing costs spike up with it, that's when the mathematical probability of a discontinuous price jump goes up exponentially.
It's all about the size of the exit door relative to the crowd trying to get through it.
That's it exactly.
So to wrap this up, we started with this idea of short selling as the villain. We found out it's actually more of a stress test for the market's plumbing. The events of 2021 showed that extreme short interest can literally break the clearing models, forcing intervention.
And a final thought on MOAs, the mother of all short squeezes. While it's a compelling theory, the regulatory data really suggests that market structure constraints, specifically clearinghouse capital requirements, act as a sort of circuit breaker.
So the system has a hard cap built in.
The system protects itself at the end of the day. It prevents infinite price run-ups because the clearinghouses simply will not facilitate them. The plumbing will shut down long before the price ever gets to infinity.
That's a sobering thought, but a necessary one for anyone trading these volatile names. That's it for this deep dive into the mechanics of the short side. Thanks for listening to Talk Tickers.